Just in the last 10 years, the US government has doubled its debt from $16 trillion to $32 trillion, and 10 of those have been added just in the last 4 years. It really doesn't seem the government is too concerned about its debt situation. Government spending over the last 20 years since the year 2000 has completely exploded as a percentage of GDP. It now sits at the highest levels we've ever seen. Now, of course, over the last 15 years, we've seen a global financial crisis and more recently a pandemic that forced the government to spend much more than it earns in order to limit the damage from these events. But government debt is now twice the size of the total US economy. That means debt is 100% the size of US GDP. Now, the average debt to GDP ratio for a developed economy like the United States is usually around 50 to 60%. It's typically what you should expect. And this is incredibly important to pay attention to because it tells you how large the debt is relative to the size of the economy that is supposed to be paying back the debt. Seeing debt to GDP at 100% is something we only saw once after the Second World War in 1945. Debt to GDP eventually came back down. Now the question is, can we reasonably expect the government to bring the debt back down over the next 10 years? Or should we believe the projections that show debt is going to skyrocket from here, which could eventually lead the United States into bankruptcy if we're not already seeing that happen today? In order for a government to get out of debt, it's quite simple. You need the revenue from the government to be higher than the amount of spending they do. Now, the problem is that government spending is projected to increase substantially from here on, while the revenue is projected to actually just be flat. So that gap that we're going to see between revenue and spending over the next 30 years is basically how much debt the US government is going to accumulate. So we're not heading in the right direction. Now, the government did try to cut spending after the global financial crisis in an effort to rebalance its budget, but that came at the cost of major social unrest movements. We saw the Occupy Wall Street movement in the US in 2011. We saw the anti-austerity protests in Europe. We also saw the Yellow Vests protests in France in 2018. Now, of course, the government is in a tough spot, with wealth inequality still at the highest levels they've been over the last 100 years, much higher levels of inequality than anything we saw after World War II, where you actually had a very strong middle class in the United States. So we are at a stage where the government wants to spend more to try and make people satisfied with their standard of living. Most people that are in a tough spot very much welcome more government spending that tries to reverse wealth inequalities. More government spending in the short term usually prevents social unrest. So at what point do we say that we're experiencing a government debt crisis? Is $32 trillion already too much? If you take a look at Japan, for example, it has a debt to GDP ratio that is actually at 200%. That is 3 times the size of their economy, and they haven't seen a full-blown debt crisis. So what actually matters when it comes to the debt is that the rate of economic growth should be higher than the interest rate of the government debt. As long as that's the case, theoretically, the economy will be able to grow out of its debt burden. Now, interest rates in the US on government debt have just made the largest move up in decades. The market seems to see more risk associated with holding US government debt, causing interest rates to rise substantially and also very aggressively over the past couple of years. One of the things that could be happening here is that holders of US government debt are selling the debt, causing yields to spike. Now, the largest holders of US government debt are actually China and Japan. So looking at what they're doing right now can probably help us understand whether we're currently seeing a debt collapse in the United States. China does seem to be offloading US debt at quite an impressive pace, especially more recently in 2022 and 2023. So China, that's offloading US debt right now, they're selling government debt, is probably contributing to some of the rise in interest rates that we've seen recently. And they still have around $800 billion worth of bonds that they could potentially sell. But if we look at Japan, their holdings have been a little bit more stable over the last decade. They still own around $1 trillion worth of bonds. Now, while Japan hasn't been offloading their holdings of US debt like China has, they also haven't really increased their holdings of government debt when they actually used to be one of the biggest buyers. So Japan has completely stopped buying bonds, and in fact, just over the last couple of years, they sold government debt in the most aggressive manner we've seen in decades, which has probably contributed in part to this spectacular rise in interest rates we've seen in the US over the past couple of years, as one of the biggest buyers of US government debt has started to actually sell some of it. On a more positive note, however, if we add GDP on this chart, you can see interest rates remain below economic growth in the United States. So despite very elevated interest rates, the US economy is still growing quickly enough to withstand them, which from this standpoint, it doesn't really look like a debt crisis. For example, in Greece during the sovereign debt crisis that we saw in 2011, where interest rates actually spiked to 35% at the height of the crisis, well, in the couple of years leading up to that debt collapse in Greece, we saw economic growth below 0%, very persistently, while interest rates on Greek debt throughout this period were hovering at around 4%. So investors quickly lost confidence in the government's ability to pay back the debt, which caused interest rates to skyrocket and the whole Greek debt market to collapse, and the European Central Bank had to eventually bail Greece out of its debt. Now, the US government may not be bankrupt like Greece was in 2011, but in 2023, it is going to be paying $663 billion in interest payments. That is literally just the interest that the government is paying back on the debt. That's 2% of GDP. It's also equivalent to how much the government spends on Medicare every year. It's through these types of statistics that you start to understand very quickly why higher interest rates can quickly become suffocating for the US government. And since 2022, we've actually just started to see some investors bet on the US government defaulting. This is a chart that shows you how much investors are buying insurance against the possibility of a government default in the US. Now, at the beginning of 2022, pretty much nobody was buying insurance against a government default. But since January, that's been on the rise, especially during the debt ceiling crisis earlier this year. Now, those concerns calmed down after the debt ceiling crisis was resolved, but you can see investors are getting concerned again over the last couple of months. That's as we've seen the largest and most aggressive drop in treasury bond prices over the last 40 years. So as an investor, you see this type of price action in the market, and of course you want to be buying insurance against a debt default. This is quite literally a US bond market collapse. The speed and magnitude at which bond prices are falling today is absolutely unprecedented, and it's substantially different to anything we've seen over the last 4 decades, where bond prices have gradually been trending higher, which also meant that interest rates were gradually moving lower. This massive breakout of interest rates that we've seen over the last year is going to trigger tidal shifts in the economy and financial markets. Now, on a more positive note, we are celebrating our birthday here at Game of Trades. So in order to thank you guys for embarking on this journey with us, we are doing a 30% discount on all our membership plans. We don't do these very often, so make sure not to miss out on this deal.